Wall Street getting a boost off optimism here on the path of rate cuts here. Fed Chair Jerome Powell saying the time has come for the central bank to begin lowering interest rates. For more on what this means for your portfolio, let's get to eToro U.S. investment analyst Bret Kenwell is joining us now to discuss. Bret, I just want to get your read through on what we heard from Fed Chair Jerome Powell and what that means for people's portfolios as they might be taking stock of exactly the assets that might need some rotation.
Yeah, thanks for having me. And when it comes to Chairman Powell's remarks at Jackson Hole this morning, I think he delivered exactly what investors were hoping for. He provided clarity where the Fed stands with its monetary policy. He said, basically laid out the path to cutting rates in September. And at the end of the day, that's exactly what investors wanted to see. I think maybe there was a little bit of hope that he would tip his hand in terms of, the size of the Fed's first rate cut, but that was a long shot. I think everyone reasonably knew that that was a long shot. And, outside of that, he delivered exactly what we needed to hear today.
With that in mind, I mean, is there, as we've continued to try and figure out what a Fed cut rate or a Fed rate cut policy playbook looks like for investments, we also heard earlier today that there's a rolling recession type of playbook that people should be right to have in their back pocket as well. What does that really entail from your perspective?
Well, that's an interesting question. When I look at the market presently, I look at it in sort of different time frames. In the short to medium term, there's clearly some headwinds, there's clearly some uncertainty, and that extends beyond just what investors are thinking about in interest rates, but it extends to geopolitics overseas. It extends to even the shakeups we've seen with the presidential election here at home. So, when you kind of consider some of these factors, and now we have, which is an even more important factor, some worries over the economy and over the labor market, which have clearly softened, but I would be hesitant to say that they've been weak. That's sort of the biggest concern at this point moving forward. We do have clarity from the Fed, which came today, which I think is a good thing. But short-term wise, we do have some sort of concerns. There's uncertainty, but when it comes to the long term, the foundations for this bull market are still in place. The earnings growth from the S&P continues to come in strong. We're on the verge of double-digit earnings growth for Q2, which is the best quarterly growth we've seen since Q4 of 2021. Expectations for 5 of the next 6 quarters call for double-digit earnings growth, which that and monetary policy are the driving factors for equities. So I think the big picture is still in place for bulls.
So with that in mind, I mean, this is what the market was craving, and you put this in your notes as well. So if this is what the markets were craving, then now what are the places, the sectors that investors should expect to outperform now that we've got this pivot?
That's a good question. I think it would be reasonable if we saw some sort of mild pullback or a pause in the equity markets, based on the idea that we came into August really abruptly. We had a big pop in volatility. Equity markets pulled back really hard into the low we saw on Monday, August 5th. Since then, we've had a really, really big rally. The S&P's back within 1% of its highs. It's up 10% in less than 3 weeks. It's a very robust move. So it would make sense if we had a little bit of a consolidation period, especially, with the headwinds I mentioned earlier. And as we go into September has historically been, we look back over, say, over the last 10 years, has been the most difficult month for the S&P. So it wouldn't be surprising if we had, some potholes along the runway, but it's still a long runway, I think. And, when I think of it, rates moving lower, I still go back to the groups that do well with falling rates, which would be, small caps, I think, are poised to do well. Utilities and real estate have been 2 of the best S&P sectors so far this year on the back of the idea that the Fed is going to lower rates. So I think, and even tech, tech kind of gets lumped into the mega cap names, which are probably a little less rate sensitive due to, their immense cash flows and their strong balance sheets. But particularly when we look at high quality, high growth tech that is more sensitive to interest rates, I think some of these names are what could really benefit over the next few quarters.